July 31, Friday, last Friday in July. We've had a very interesting 2 weeks, and things are not going according to plan. The Fed continues to say, hold us back, we're coming, we're going to raise rates. All indications would be September, and yet mortgage rates have come down. Long-term rates are coming down. And in the strange background, let me begin with the basics. The Fed's job is to encourage the economy to grow as fast as possible without inflation. And if inflation begins, to lean against the economy to slow it down, to keep inflation from getting going. The Fed lives in a world of lags in which when it raises interest rates or cuts them, it takes time for the change to have effect. And so the theory is, sitting here at 0% for 7 years, we have thought that the Fed wanted to come up from zero, in part just to get off zero, to go from extreme ease to somewhat less ease, to come up from zero gradually so that if inflation began or hazards grew, then it wouldn't have to raise rates quite so fast all at once. All of that has changed. In very technical stuff in the piece beside this recording, the Fed is indicating that the economy is already growing faster than it can sustain. How do you know how fast is too fast? Most basic equation is an economy can grow as the population grows. Our population is growing about 1% a year. Then on top of that, you can tack the increase in labor productivity, which is low right now. It's lower by, it's half what it ought to be, at about 1% per year. In theory, if your economy then grows population plus productivity, incomes can grow without creating inflation, but the economy as a whole can't grow faster than that 2%, 1 plus 1. This has come as something of a shock to a lot of people, and part of the information came in a leak from the Fed 2 weeks ago, unintended, which says that it may be that the speed limit of the economy is only 1.75. We grew in the second quarter at 2.3%, and even that feels slow. Strange as it can be, I mean, the Fed meeting broke on Wednesday. Mortgage rates were 4.25. We're now sitting between 4 and 4.125. And today, just this morning, we got the employment cost index, broadest index of incomes in the economy, includes even benefits paid to employees. And the ECI had the smallest gain since 1982. No sign of income growth. I am very much on the side of concern that the Fed, for historical reasons relevant to an economy that doesn't exist anymore, is going to try to shoulder into the economy and slow it down actually soon, when what the world needs is economic speed. There's nothing negative, there's nothing to worry about in what I've had to say today. It looks to me as though what we get out of this may not be as fast as an economy as we would like to have, but with it, we get no spike in interest rates that does harm to housing. That we may stay right here in the low fours. The high of the year may have passed, but it's just as strange as it gets. Now look forward. All I know for sure about forward is that next Friday we get employment stats for July, and we'll start all over again when we see how the job market performed in July. See you next Friday.